Hello, and greetings from Philadelphia. My name is Kate Maloney, and I'm a program director at Wharton Executive Education. Thank you for joining our LinkedIn Live event. In the spring of 2021, we had a similar event on the topic of SPACs, which were all over the news at the time. Now we bring you a discussion on another topic we all keep hearing about, inflation. With us today, we have three Wharton professors from our world-renowned finance department to share their perspectives on investing in a high inflation world. I hope to see the same level of engagement that we saw with our previous live event, so please use the comments to post your questions, and we'll do our best to answer as many as we can. We've also allotted the last 20 minutes of the hour to focus on your questions, so stick around through the end. While we won't be able to address each and every question, we invite you to consider attending an executive education program, either on campus, in a live virtual setting, or by taking a course at your own pace through Wharton Online. The same Wharton faculty who teach in our top-ranked undergraduate and MBA programs teach in our executive courses, three of whom you'll meet now. So without further ado, please join me in welcoming Professors Joao Gomes, Nick Roussanov, and Itamar Drechsler to our live event, and I will turn it over to the chair of Wharton's finance department, Joao Gomes, to kick off the discussion on inflation. Welcome, Joao.
Well, hi, Kate. Thank you very much. And hello, everyone, and welcome to this Wharton LinkedIn Live event, where we'll discuss some of the latest research insights from our finance faculty. Today, I am joined by two of my colleagues, Nikolai Roussanov, the Moisés Y. Safra Professor of Finance and the head of our Wharton On the Market series, and Itamar Drechsler, the Irwin Miller Arthur M. Freedom Professor of Finance and the co-director of the Rodney L. White Center for Financial Research. Together, we will talk about inflation, why it matters, whether it's here to stay, and how it may impact your investment strategies. As Kate said, we'll also take your questions, so please make sure to use the comments feature. Let us begin. Here in the US, headline inflation just hit 7%, a number that we haven't seen since 1982. Even after we exclude the historically volatile food and energy components, the so-called core inflation was still at 5.5%. Numbers in Europe are a little lower, but it seems probable now they will still have further to rise. Nick, take us through the basics a little bit and talk to us about why inflation should matter for investors.
So let me jump in here for Nick, because he seems to have a technical issue for a moment. He'll be back here in a second. So there's a couple of reasons why inflation is very important for investors. First, the most obvious one is if you consider nominal assets, and such as U.S. Treasury bonds or corporate bonds, almost all of which are just nominal, meaning they pay pre-specified, cash flows that are fixed, that are not adjusted for inflation. Then obviously, if you have inflation, then for bonds that were already issued in the past, the value of those dollars in real terms is less. So the returns on those things will be very bad. Now, if inflation is unexpectedly high. The other part of it is, which is closely related, is that the Fed standard policy for the Fed is to raise interest rates in order to try to decrease the forces that cause inflation, and we'll talk a little bit about why that would be the case. As a result, they raise the nominal interest rate and also the real interest rate, which then through the discount rate effect decreases the prices of both nominal assets such as bonds, but also real assets such as stocks and real estate. So this is something that investors are particularly worried about right now, the concern that the Fed will have to raise interest rates a lot, and that has a very powerful effect on all asset valuations, namely to make them go down.
Okay, since we don't have Nick, people talk a lot about expectations and the potential for unanchored expectations. You've done some work on this in the past, and whether this sense that investors may at some point decouple from this 2% view on inflation is going to affect the economy long term, and how the Fed should respond to that, and whether the Fed should respond to that. Do you want to talk us a little bit through that, and why should that matter for investors?
So I think one of the things that matters a lot for this, investors at least are very concerned about it, and you hear a lot of discussion, it's constantly in the background, is the belief, and we will a little bit later go into the history of this, that people's expectations about future inflation are actually a driver of the inflation, meaning that if people got used to inflation being, let's say, 2%, then that's likely to keep it at 2%. But if a series of events happen that make inflation more likely in their mind to be 4 or 5%, then that in and of itself drives inflation, more towards 4 and 5%. Now, if that happens, it means that the inflation will last, according to this narrative, for a long time. And not only will the inflation be high, but in order to fight this inflation, the way that policymakers believe and the research that's been done suggests that they'll have to raise the nominal interest rate even higher than that for a while. And the combination of those two things is likely to have a very big effect on the discount rates, that go into the pricing of assets, and to bring prices down a lot. And I think constantly then in the background is this concern, when is it going to, if there's such an unanchoring, as they call it, of inflation from the 2% to a higher number happens, when could we be expecting this to happen? It's that part is kind of something that's ambiguous. We don't know, according to the theory. Like what causes people to shift from one equilibrium of expecting something to another is not a question that people have much sort of concrete understanding about.
Okay. If Nick was here, and hopefully will join us at some point, to be talking about his research on historically what is the impact of inflation and inflation risk across various asset classes. You and I know that research relatively well, so maybe we can talk through it a little bit. Historically, one of the things that Nick found is that it really matters whether we're talking about core inflation or just headline inflation. The market seemed to respond a lot more to core inflation. And on top of that, they respond a lot to surprises. It really matters whether the inflation is sort of surprisingly high or it just remains elevated for a period of time. Do you want to talk us a little bit through that? I think that's probably what most of our audience is interested in. What asset classes seem to do better? What does the history say?
Right. So Nick has done a lot of research on this, and what he's found is that it's that what really, like, if you talked about this, is that there's kind of two versions of inflation, and one of them is kind of the headline number, which includes everything that goes into the inflation basket, and the other one is core, which takes out things like food and energy that are very volatile, right? They change, all the time. And so that one is less persistent, and if it goes up or down, it's much more likely to revert in a short period of time. And so what Nick found is that it's really movements in the core number, surprises upwards in the core number, that have a really strong impact on asset prices, not the headline number. And I think the reason for that is intuitive. It's that the core doesn't change much, and it's more persistent. So if you see an increase in that, it's much more concerning in terms of what's going to happen going forward. And Nick shows is that when the core number goes up, this has a very negative impact on basically all assets, almost all assets that you can tell, including, of course, nominal bonds for the usual reason, but also stocks, which you might be surprised about if you come from the point of view that stocks, are real assets, meaning if prices go up, then the cash flows these companies will be higher. And so the inflation, the textbook explanation would say that maybe inflation is neutral for stocks. Maybe even it's good for stocks if people run away from bonds towards stocks. But at least historically, that has not been the case. And we'll talk about that more in a little bit. And what he's shown is that in particular, if you look at periods where core inflation is above 4% versus periods where it's less, during periods where core inflation is above 4%, the returns on these assets are quite poor, almost essentially across the board. And that's during the whole period where it's 4%. But the real unfortunate thing happens when you first get a surprise that puts the inflation rate unexpectedly high, above the 4%. In that case, what he shows is that all of these asset classes take a plunge at that point. And like I said, I don't think that this is intuitive, because when you see the surprise is when you suddenly discover that there's a potential for this problem to occur. People start to worry about the unanchored expectations. People worry in particular about reacting very strongly by raising rates. And surprise means surprise to the Fed as well. So people are surprised themselves. They're also watching the Fed.
I think the last point is really important, and I thought his research really speaks to the world we live in, and this question whether inflation is going to linger above 4 or how quickly it's going to come back down to more historically, or at least recently, historically more plausible levels. One asset class, or maybe two asset classes that people think offers a lot of inflation protection, or is let's say gold and commodities, perhaps also real estate and REITs. Tell us a little bit about the performance of those asset classes, historically at least. What does the evidence say? How do they perform in these periods of relatively elevated inflation?
So I think that is really interesting to ask. So I think most people think of gold, to the extent that they think of gold, as something that should be a safe haven in times of inflation. And I think Nick found that in times of high inflation overall, gold doesn't do particularly well. But in times of surprise, then in that case, sometimes it is in fact the case that gold goes up in value. Now, for real estate, I think the evidence on real estate is a bit mixed. So in a period where, again, we'll go to this soon, that we had very high inflation was the 1970s. In that time, overall, real estate did incredibly well. We had a real estate boom in the United States, both in terms of prices and in terms of the amount of building. However, during the periods of the 70s, when inflation really spiked, real estate did very badly. So it was a very volatile time period for real estate, such that when inflation spiked and interest rates spiked, real estate did poorly and construction slowed down a lot. And one obvious reason for that is that mortgage rates went way up. And so people had a tough time getting mortgages. Construction companies had tough time getting the capital they needed to build. But outside of those periods, people treated real estate very much like an asset that was a safe haven towards inflation. And so outside of the very high inflation times, real estate did extremely well. So if you go and look at anywhere in the internet, you could see how good actually this real estate did. And I'm talking here in terms of real prices, meaning after adjusting for inflation. Of course, if you also add in the inflation and look at the nominal price, then of course it's going to be very high because it's got that piece added in.
Mm-hmm. Let me ask you one more thing, which shows up in a lot of analyst discussions, this how growth and value stocks are impacted by inflation, and link it to something you said earlier about the surprises of inflation, the problems the surprises it presents to the Fed, and how the Fed may respond in terms of more or less aggressively in terms of hiking interest rates. But what is the evidence on growth versus value? Is there a compelling case, as you often read, to say that value is perhaps more immune to inflation? And why do people say that? And is the evidence supportive or not?
This has come up in the last couple of weeks as the inflation scare has led to some days where we see tech, for example, leading on the way down. And so there's a kind of common argument made that growth stocks, by the very name, they're growing fast. So disproportionately, if you think about it, the profits they're going to make, the cash flows they make are further out in the future, right? They typically are small now and are not making that much, but they're going to be far out in the future. So then the same logic as for bonds would suggest that if there's an increase in discount rates, then of course it multiplies, it compounds over time, then the further out cash flows decrease in value more than the nearer term cash flows. That is, they're more sensitive. And then that should mean that growth is more sensitive to these increases. The shorthand for it is people say they're like longer duration, where duration is, the term that means the sensitivity to a change in the interest rate. So longer term bonds have higher duration than shorter term bonds. And by this reasoning, growth stocks, cash flows, and therefore their value has a higher sensitivity than value. However, in the data, that doesn't actually really seem to be the case. So although people seem to sort of like this intuition, and perhaps there's something to it, it wasn't really the case that growth has really outperformed value during the periods where we saw core inflation over 4%. So either that's not the right logic or something else is going on. I'm not, I don't have a strong view on that.
So even before, I guess yesterday's roller coaster is a really good example of the palpable nervousness that you sense among investors for a few months now. And historically, we know, and we've seen from this evidence, that every time there's sort of news of announcements of high inflation, markets get spooked very easily. You've connected this to expectations of interest rates and monetary policy actions. Talk us a little bit through that, and maybe what else goes through the mind of investors as we sort of see this increasing nervousness in the last number of months.
So I think you said it, which is that the big elephant in the room is this idea of expectation. So the lesson that academics and practitioners and apparently market participants, took away from the period of high inflation that was the 1970s, ending around 1982, was this idea that you can lose control of people's expectations of inflation. And given that inflation was increasing over time during the 1970s, and that there was a lot of volatility in the economy during that time, was perceived as something extremely negative. And then how the story is that how did we get out of that period was that Chairman Volcker, Paul Volcker, very famous for this, needed to raise interest rates extremely high, which he did, and cause a terrible recession to get economic activity to decrease enough so that people couldn't raise prices, okay, because the economy was in such bad shape, and sort of put the economy back into a situation where people didn't expect prices to rise anymore, and then reestablished kind of the normal inflation regime that carried us through the next decades, in which for a long time people credited with the longer expansions and less volatile business cycles. And so the lesson of the central banks and of a lot of people was we have to maintain this regime. And if we have a risk to this regime, it's very important to sort of treat the disease early before it gets out of control. And so whenever there's a concern that perhaps we're not treating it, perhaps inflation is going to run away from us, then investors can get very nervous. They can get very nervous that we'll have to raise interest rates a lot, and the combination of inflation being bad and interest rates being high could spell really bad times for the stock market. So I think it's that, and the fact that it's not clear what would be the trigger for it. It's a bit like public opinion. When does it change? Who knows? It's sometimes surprising when it changes. So,
as I said in introduction, and you've made that connection now, inflation has not been this high since 1982. And I think a lot of the analysts, a lot of what you see written is based on lessons from this previous era of high inflation, which was roughly between the mid-1960s and the early 80s. And you've studied this in great detail. Give us a little bit of the factual history lesson about it for a few minutes.
Okay, so let me show you some plots. So I have some interesting plots. I've been studying this period for a while. Actually, it's funny. It's ironic because my co-authors and I began studying this back in 2018 or 19, before any of the inflation stuff really came up. And we studied it because it's so central to the way that policymakers and monetary economists think about their field. Because this period, which we call the Great Inflation, even though it wasn't so great, it was actually kind of unpleasant, was the main experience that the United States and most Western countries had, developed economies, with high and rising inflation. Afterwards, since we didn't, there's not that many lessons to be drawn from it. So let me just, to give everybody a little bit of a history lesson here, let's look at a basic chart of what happened during this time period, which is this roughly 17 years, starting in 1965. And people talk about it a lot, so I think it's useful to actually see the data. In the 1960s, the US economy, as many European economies, was doing extremely well. There was very fast growth. These are sort of the halcyon days that people talk about, back when income growth was strong, it was easy to get a job and so forth. This is the post-war boom. And inflation was very low. You can see on this graph 2 lines. One is annual inflation over the following year. So at every point, you see what inflation was at that point for the next year. And then it's the same thing for the Fed funds rate, the Fed's policy rate, the short-term interest rate. And through the 60s, again, the inflation was very low, similar to what we've been having, prior to this time period. And interest rates were very low. It sometimes surprises people to know that we had very, very low interest rates before already. And then starting in 1965, inflation started to go up. There are many stories for why that is: a very hot economy, the buildup to the Vietnam War, the Great Society, whatever the case may be, it started to go up. But what happened was it started slow, but as you can see, inflation increased first in 68 to 70, and then in the Fed followed by raising interest rates quite a bit. And then every time there's like a couple of cycles where inflation rises higher, and although it goes down afterwards, ends up at a higher trough and a higher peak than it did before. By the mid 70s, it reached double digits, and by the end of the 70s, 14% at one point. And I should add that every one of these cycles was accompanied by growth-wise and income-wise quite a lot of volatility. So before I show you that, let me just also describe that the end of this inflation, which is what people attribute to Volcker, came after Volcker raised the Fed funds rate in blue to about it's almost 20% during 1981, and caused this very major 1981-1982 double dip recession that I think still traumatized the market till today. So just to show people why people were so upset about inflation over this time period, and whether inflation is really the thing that caused this or not is an open question, but it was definitely associated with it. In green here, I have what happened to GDP growth, real GDP growth that is adjusted for inflation over this time period. And coming into the time period, the US had 8% GDP growth. You see that in the green line. But every time inflation was going up, at the same time, GDP growth was falling fast. You see this in each of these 3 to 4 cycles, beginning, in fact, with the very beginning in 1965, and each cycle getting progressively worse drop in GDP. When inflation was down, GDP would come back very strongly. So overall, the 70s for average growth were not very bad, but the cycles were frequent and very harsh. And this is what people called the stagflation, because every time inflation went up, GDP growth fell a lot. So you had both low growth and higher inflation.
Mm-hmm. And I think this strong negative correlation just really stayed with us. I think that's a really important part of the consciousness that we have now, that just high inflation comes with bad news. It just brings, it means that the economy is not going to do well. And I know you don't find this narrative compelling anymore. You and I have had lots of discussions about this. Can you summarize really quickly for us today? What do you actually now believe drove this gradual rise in inflation through the 70s in this period, and why did we see these recessions, ever more pronounced recessions than in the mid to late 70s?
Right, thanks. So this is where I will go a little bit outside the mainstream here and talk about my research, which has put forward a different explanation, which I have presented in a lot of places, and I think a lot of people find compelling, though it's very difficult sort of to let go of a narrative that's been so widely told. But I have a very different view of what caused this time period, and that's relevant also for thinking about what we have to be concerned about today. And with my co-authors, we've worked on providing a lot of evidence for the following view. So our view is that the main problem in this time period and what caused the economy to sort of spiral in this negative direction was a very powerful and at the time very well-known financial law called Regulation Q. I'm sure there's some people who work in banking that are familiar with the name of this law. This was, think of it as a kind of financial repression. What that means is that the central bank, the Fed, had a rule that said that banks could not pay a higher interest rate on deposits than the ceiling or cap that was mandated by law. And what I have on this graph is the cap. That's in black. And so banks paid this cap on deposits, but they could not go above it. It's a very long and interesting story of the history of this cap and why they chose to do this. I should add that this was not just in the US. Similar kinds of caps were used in many countries around the world, as were other kinds of financial repression, though while different in form, had effectively the same function, which was to try to reduce the credit provided by the financial system, in part because the central banks thought that was going to help reduce inflation. Now, we argue that it was, in fact, doing the opposite. So what you see here is that every time that inflation started to go up, and starting with 1965, where this cap was first frozen and not allowed to move up. So prior to that, the cap didn't matter because it was high enough such that it was below the interest rate that the central bank set. At that point, they decided not to increase it. From that point on, while they increased it sometimes a little bit, as you can see, it basically stayed quite flat, even as inflation tended to exceed the cap. When inflation started to go up, people couldn't get a fair rate on deposits. And so their savings accounts were making a worse and worse real rate, which think of it as the difference between what you were getting, which was about 4 to 5%, and the inflation rate, which could hit at times, like I said, 12%, and in fact, even 14%. And what we argue is that it was the combination of this repression, this regulation, that really harmed the economy. It harmed the economy in two ways. One is that depositors, whenever they were hit with high inflation, felt like their savings are a disaster, are doing very badly. And so the ones who could find other places to invest streamed out of bank deposits. It was not everybody, but it was a sizable fraction of usually wealthier people. And as a result, went to try to consume more and actually made the inflation worse. The second part was, maybe even more importantly, and I think not well understood, is that the policy was intended to limit the creation of more bank loans by banks by, in fact, causing depositors to leave, as I've described. And it did that. It did it a bit too well. So what happened is every time that inflation rose, deposit growth became quite negative. So this is what I've graphed here. You can see that completely contemporaneous with these inflation spikes, people are leaving the banking sector, pulling out their deposits. And the problem with that is banks are very important. They're important now, and they were even more important then. Banks then had to cut credit to firms because that's what they do with deposits. And here's the connection to today. This was like a supply disruption. It wasn't COVID. It's not because people were getting sick, but it was because credit was very scarce. It had to be rationed to firms, and the cost of credit went way up. It was all very artificial because it was caused by this policy law. But so every time deposits flowed out, firms were short on credit, and they had to fire people, cut production because they could not finance their operations properly, and increase the prices of their products to meet the higher cost of the credit. So we spent a lot of time showing all of this across different industries and across different banks. You can see the research on my website if you like. And so that explains, under our theory, why each of these high inflation episodes led to these sudden and severe recessions, and at the same time when the inflation let down and deposits came back, as you can see, they were able to provide credit and the economy bounced back. Okay, so if we go back, in fact, to a previous slide, you can see that the output falls and the deposit falls are very contemporaneous. So that's this alternative theory, which puts supply disruptions very much at the heart of that inflation. And I'll comment in a little bit later on the connection into the supply, the differences, but also similarities to inflation being caused by supply disruptions today.
That was actually exactly what I was going to ask you I think, do you connect what happened in do you think that's a relevant comparison for us today? I think that's something in a lot of people's minds, and in particular this sense that inflation is going to come with significantly reduced growth and possibly a couple of recessions in the next number of years or so, depending on how the Fed manages or mismanages inflation. How do you connect those two? Are the supply chain issues that we hear about today somehow different manifestations of the same supply pressures we saw in the 70s?
So I think that's the important question. So I should say, before talking exactly about that, let me say that the difference between this explanation and I think the one that's still held in very much by many people and the policymakers is it's not so much about people's expectations taking on a life of their own. Though I don't deny that could have a role. In my personal viewpoint, that role has been tremendously exaggerated. I think that people's expectations tend to follow whatever is being driven by the fundamental forces on the ground. In this case, the credit disruptions, what people call the credit crunches, not that the expectations themselves take on a life of their own and drive things. And that's important because if it's really the expectations, then yes, perhaps the Fed has to take persistent, drastic action. In the 70s, there was the feeling that the Fed simply cannot control this, that they don't know what to do or that they don't have the guts to do it. Whereas I'm arguing it was something else. Now, to your question, I think there is a similarity and a big difference. So the similarity is that if it was really supply disruptions that drove it, it can explain, A, why the economy tanked every time there was inflation, which the standard explanation really doesn't say. It tends to blame oil, but Nick can comment on that in a little bit. I think that's not the case. And so today we also have a supply disruption. Now, the question is how long would it take to clear up the supply disruption? In the 70s, it wouldn't have taken long at all if they understood that it was man-made, that it was caused by this inability to pay the fair rate on deposits. So what ended the 70s was when they finally removed this cap in 1979. And if I show you in the previous slide, you can see that's when deposit rates jumped up 7% in a single year, and billions, hundreds of billions of deposits flowed into new unregulated deposit accounts. And the timing of that coincides very nicely with the fall of inflation. We have a lot more work in our research trying to bolster that point. Now, today, the question is, how long will it take to clear up our supply disruptions? They're not imposed by any regulation or law, at least that I know of. It's been due to COVID. It's been due to a change from consuming services to goods. But if those supply disruptions become less, if there's a new variant that prevents supply from clearing up, then it's my point of view that this will not continue for a 17-year period or anywhere near that, and that it won't necessarily lead to these kind of stagflation unless the supply gets really, really bad. Up to now, it's been bad, and it's probably prevented us from growing faster, but it isn't as bad as what these credit crunches were that caused growth to literally be negative.
Thank you. Thank you, Itamar. Before we turn to take some questions, I just want to give Nick a chance to, since he just managed to join us, to actually maybe show, we had one slide to summarize your research, I guess, maybe even 2 slides. Maybe we can just see the data so our audience can just have a visual depiction of what Itamar mostly talked about for future reference. And have you just talk through some of the key highlights that maybe we didn't mention? Thank you. Go ahead, Nick.
Yes, thank you, Joao, and thanks for everyone for being here, and sorry for being a little delayed by power issues. And again, thanks for tuning in. So this graph that I wanted to show you is really kind of distilling the research on how different asset classes perform during episodes of high versus low inflation. And Joao and Itamar already discussed the fact that it is the core inflation really that the Fed watches, because that's the component that is the most persistent. So stripping out food and energy from the headline numbers. And it is also the component of inflation that is most important if you look at asset prices. In fact, as the news about inflation come in, the stock market reacts most negatively to high core inflation. And in fact, sometimes people think that the stock prices actually, they represent claims to real cash flows, so they should be unaffected by inflation and should even move positively with inflation. Well, that's a bit of an illusion that is actually also due to the role of energy. Energy over the past 20 years has been highly pro-cyclical. So even though we had 50% rise in gasoline prices over the last year, much of that had been driven by the fact that the economy recovered strongly from the COVID shock. But once you strip energy, you see that core inflation affects negatively not just nominal bonds, that's the most obvious asset to be affected, but also stocks. And whether you're talking about US stocks or world stocks. Here I'm dividing data into quarters where core inflation is either above or below 4%. 4% is a relatively high number, and that's probably what we can expect for the next year, if not something higher. And then you see that the stocks on average over such quarter come in at 3.2% annualized, so not even breaking even in real terms, not clearing that bar of inflation. And world stocks and growth stocks do even worse. It is interesting that value stocks actually do beat that threshold, and value stocks generally do much better than growth stocks in these inflationary periods. And in fact, a lot of the discussion recently has been about, well, tech is being clobbered because tech is representing these long duration cash flows. Well, while we don't necessarily see evidence of that kind of long duration effect in our research, we do see that value is less affected by the periods of high inflation than growth. Perhaps that's because value stocks value companies are more heavily indebted, and so their debt liabilities become, in some sense, less burdensome in real terms when inflation takes off. Now, of course, bonds. Again, it's not surprising that bonds take a beating when inflation spikes. Corporate bonds do a little bit better than treasuries. They, of course, have the credit risk premium. And again, highly levered companies kind of get a bit of a reprieve when inflation spikes and the risk of default is a little bit reduced. Commodities are one asset class that is talked about as being kind of the inflation haven. And we do see a little bit of that. Commodities do outperform inflation when inflation is high. Generally, they underperform other asset classes, but here looking at investable, index, GSCI, Total Return Commodity Index, it does outperform inflation. REITs, on the other hand, real estate investment trusts are not that real in terms of being real assets. They behave more like stocks and bonds, largely because they're ultimately claims to payments that tenants make to owners of the properties. And those payments don't get adjusted so frequently. And so, again, the cash flows deteriorate in real terms, and REITs suffer when rates spike.
Thank you. A couple of classes asset classes that you don't have there. One I know because the time horizon is relatively short. The other one probably even short. How do you think inflation index bonds? How do they think they perform? Is there evidence that they offer protection against inflation in these periods?
So inflation index bonds are really the only truly inflation hedging asset, inflation protecting asset, because they are ultimately explicitly indexed to inflation to ensure that their real purchasing power is preserved. I mean, it's not, of course, exactly precise for a variety of reasons I'm going to get into, but ultimately, TIPS, the Treasury inflation protected securities, are the one kind of asset that is meant to protect investors against inflation, and it does its job. It's just at the moment, investors will have to put up with a pretty negative real yield on those. But that is the kind of ultimately the true real yield that you're earning. If you're buying nominal treasuries, of course, you're earning also a negative real yield given the inflation that we're observing, but potentially pretty substantially so. But to a lot of investors, it doesn't maybe look so bad when they see positive yield as opposed to the negative yield.
The other asset class, it won't surprise you that a lot of people have questions about. I have a question from Adrian and Ricky here. It's crypto. And we have very little data on that, of course, but so do you still think, do you believe that this is a market that will hedge inflation, in particular, maybe very high inflation?
So I think it's a very tough call. So people think that the crypto has sort of replaced gold, and even though in this graph it looks like gold doesn't do so well when inflation spikes. Actually, if we look at quarters when inflation is higher than was expected, so it was really kind of an inflation surprise. In those quarters, gold does shine. So it actually outstrips the general commodity index. That's the bar on the very right, at 10.4% return annualized. It's really the only thing that really outperforms kind of the rest of the commodities, with pretty much all of the other asset classes getting completely clobbered by these kind of spikes of unexpected inflation. Of course, look at what happened in the last few weeks in the markets. This is exactly what we have been witnessing. And since Joao, you asked about Bitcoin, and I started with gold, we will have all seen what happened with Bitcoin. It is true that over much of last year, Bitcoin has traded in a way that is somewhat correlated with investors' expectations of inflation, as we can read from other asset prices like inflation swaps. And yet, when these fears finally materialized, Bitcoin tanked. So it doesn't seem like it's such a great protection about a protection from inflation, given its recent behavior. Even if it is correlated with inflation expectations, it has so much basis risk, quote unquote, so much variation that's completely unrelated to those expectations that it swamps any hedging value Bitcoin seems to be able to provide. It is true that in some sense, gold is a good hedge for inflation because people believe that it is. So maybe someday something like Bitcoin or another cryptocurrency will replace it as the ultimate inflation hedge, because people will believe that it is a great inflation hedge, right? It has no intrinsic fundamental value. Well, gold maybe has some, but with Bitcoin, other than some transactional value that is not very high, it's ultimately its value hinges on people's belief about its kind of future promise and its ability, in particular, to stand up over inflationary periods. But we don't know if that belief is going to materialize and how it will play out. Of course, it is in principle a possibility.
Let me ask Itamar a couple of questions. Mark from Ohio asks, once supply disruptions are mitigated, if you think that is what's going on, are we still not left with sticky wage type inflation with that's going to persist and generate rises in the core for a number of years ahead? And connected with that, a question from Golib from, do you think the Fed can effectively tackle high inflation? Does he have the tools? Will he be able to bring us back to the 2%, 2.5% range that maybe its long-term goals?
Those are really excellent questions, especially like the question about the Fed. So in terms, let me start with the first one. In terms of the sticky wage inflation, I don't think it's a matter of years. So a couple things. One is it's been well publicized that wages have gone up, but they've only gone up higher than inflation, at least the headline inflation, for the lowest wage workers. So actually, let me bring up my slides for a second. Okay, and you can actually see one thing that relates to this. I always like to go to the data if possible. So here's a chart courtesy of BlackRock. Maybe they put this out a couple days ago. Maybe some of you have seen it. what we've seen is so there's a second part to this chart, but I did not include it. We've seen that prices have gone up the most for goods because people are spending way more on goods than they did before, as you can see here in the green line, and inflation of goods prices has gone up while inflation of services prices has not. However, on the wage side, it's actually the wages of service employees who have seen the highest level of quits that have gone up, whereas there's not been that much increase in the wages of goods producing employees. Now, I think that you would get a bit of a continuation of wage increases, perhaps, as a little bit of a catch up, but I don't see this as something that goes on for years, unless you are very concerned about this kind of effect on expectations lasting for a long time. And that's why I think ultimately the very big fears versus the not so very big fears is all about whether you think that this thing has its own kind of animal spirit, or is it just a reflection of some kind of hydraulic fundamental thing that's happening. And I'm more in the second camp, whereas I think the typical discussion has been more in the first camp. The question of can the Fed actually get control of inflation? So I think the Fed's ability is limited in the following sense. I think if you see that it's an issue of supply chains, then I don't think the Fed can do much for the supply chain. What they can do is they can try to decrease people's demand such that the supply chain issues are not as much of a problem because people don't demand as much. Is that a great idea? I mean, we've had a pretty strong economy, and I think that's been a good thing. We're kind of focused on the negative part of the inflation. I don't think we would have preferred an economy with very poor demand, a sort of slow recovery like we had previously. But it seems that the consensus is that at least slowing demand somewhat is a good idea. And I think on the margin they can do that. But ultimately, I do think this is a supply chain issue. So one comment I want to add, maybe Nick has a comment about this as well, is here's a graph I think people will find useful also for thinking going forward. It's the chart I really like. This is increases in the prices of goods along the supply chain. So the very early stage goods materials like raw materials and kind of early parts of the manufacturing process that are pretty raw is in purple. And the final stage goods increase month over month is in gray. So you see, and this is since the beginning of COVID. So you see two things. The purple is much more volatile. So the early stage stuff tends to vary way more than the final stage stuff. And you can see the part where we had the deflationary part where we shut down the economy. You see this thing started, the difference between them, think of it as increase in the prices of materials that have not yet flowed through to a final stage and should be predictive of what's going to happen in the future. So you can see that very much in 2020 already, there were already signs that we're going to have an uptick in inflation. And then in the middle of the year, the inflationary pressures for the future were very strong. Going towards the fall, they were actually decreasing. And if you recall, CPI numbers were actually going down. And then the Delta wave hit and things got worse again. I think that did make things worse. Right now, they're not as bad as they were. So it can take a while for this to flow through, while by I mean several quarters. But unless Omicron or some other variant messes this thing up royally again, I think it suggests that the pressure to continuing increase prices is down.
Mm-hmm. There's lots of questions about the Fed and what the Fed is likely to do. So let me just follow up on that a little bit with Nick now. Shankar asks us, at what level do you expect interest rates to settle down at the end of 2022? I think markets right now are forecasting about 4 hikes, or pretty much baked in. Balance sheet maybe going down $500 billion or so. I don't know if you agree with that. But the question that I really have for you is, what do you think that will do to, let's just say, stocks and bonds? That's a question actually from Fernando. All baked in based on your research and based on what do you think the Fed is going to do? Where does that leave the stock and the bond market in particular in 2022?
Right, thanks. That's a great question. Of course, the markets right now are trying to process I think that's very, very questioned. And a lot of the turbulence that we have seen is very much due to that. Jay Powell said in his last press conference effectively that the sort of the unwinding of purchases will be underway, and by March, basically there will be no new QE purchases, and the Fed will effectively be ready to start hiking rates. And the panel of U.S. macroeconomists that I participated in, the group effectively came up with a consensus of the beginning of Q2 as the beginning of rate hikes. By now, everybody is already, I think, well aware of that, and the markets, I think, are predicting, as you said, Joao, 3 to 4 hikes by the end of the year. So that puts us at about 1%, maybe 1.25%. And it all really depends on, I think, how much markets behave, how dramatically markets behave in response to that, and whether the Fed still has a stamina to keep going through with these hikes over the course of the year. If we see kind of a serious pullback in the market, not what we have seen over the last week, but something that's truly forecasting an immediate impending recession, which is not what the Fed wants to do. Of course, the Fed does want to rein in inflation, but ultimately its goals are price stability and full employment, and it will do everything in its power to strive for full employment. And I think they will ultimately pause on the hikes if they see that that goal kind of compromises the inflation fighting goal. If given that effectively they can't do much really on the inflation front, as Itamar has described, all these supply chain issues are not something that the Fed can alleviate. Yes, potentially the Fed can reduce demand by effectively taking some of the let's say air out of the stock market by hiking rates rapidly, but that is going to do damage on a lot of fronts, and not just to firms, and perhaps on the supply side that should not be maybe as much of an issue. Firms that wanted to raise capital by now have done so. Equity markets have been very I think welcoming to most types of firms over the last year. But at the same time, investors are also workers, and part of the reason the Fed has been struggling with achieving full employment is this great resignation notion. The fact that people basically, a lot of them decided that it's not worth their time to go to work now. Their 401ks are doing well. A lot of them taking early retirement, and pursuing better things in life than work. Well, what will happen as the Fed potentially take some air out of the market? Well, some of those 401ks are not going to look as good, and maybe people will actually come back into the labor force. That is something that nobody has really discussed much, but it is, I think, is a real possibility.
Mm-hmm. Itamar, I have one question for you that connects to your discussion about the financial repression characterization of the 1970s. Greg asked us to comment on the impact of these Fed actions on floating rate loans. And I one of the things that the last time the Fed went through a tightening cycle in 2018, spreads went up maybe by 50 basis points or so on maybe it was $750 billion of tightening. Now we're forecasting maybe $1.5 trillion or so for the next year and a half. So maybe 100 basis points, 150 basis points increase in spreads. That sort of feels like the sort of contractionary financial conditions or tightening of financial conditions that reminds me a little bit of what you said about the 1970s. Do you think that will actually perhaps not be effective and create the sorts of extra supply chain stresses that you emphasized earlier?
That's an interesting point. I would expect that the impact would be on long-term rates like government bonds, because when the research I've done, which a lot of it is on banking, is when the Fed increases the interest rate, and banks then usually do not increase deposit rates that much, people pull deposits out to some extent, not like in the 1970s. In the 1970s, they really couldn't raise deposit rates at all. So the effect was much stronger even than they had would want, even if they had control over it. So it was overdoing it by a lot. But since that time, it usually results in some deposit outflows. And the kind of deposit that are flowing out are the ones like savings deposit, household deposit that the banks use to buy long-term mortgages in government bonds. And actually, more recent research I've done shows that one of the reasons long-term rates are so low now is because the massive amount of checks that people got, they deposited them, these are middle-income people or less, deposited them into checking accounts, not usually where wealthy people put their money. And then the banks use this to buy tremendous number of mortgages and then treasuries. They typically don't buy treasuries, but they sort of ran out of mortgages to buy. And sort of that on top of QE has kept long-term government rates very low. It's more likely that we'd see an increase in these long-term rates rather than the kind of funding that firms need, which is commercial and industrial funding, which is more the short-term floating rate stuff, and historically has not been affected negatively by this outflow of deposits. So I think it's actually more likely we'll see the long end start to rise if they actually raise the short end, but the major effect would be on mortgage costs, not on commercial firms.
Okay, thank you. I think we're almost out of time. I just have one question for both of you, a really short answer question. Where are you invested now? Where's your money?
Not in bonds.
Not in bonds.
And I did make sure to refinance my mortgage at close to the bottom of rates. And as far as equities, I do have a bit of a value tilt, and it's been performing poorly over the years, but I'm hoping that this is finally the time that it will redeem itself. And I have increased my commodity exposure a bit, although nothing as large as I would have liked exposed now that we have seen a bit of a rally in commodities over the last year.
How about the dollar, really quickly?
So the dollar, I'm actually bullish on the dollar precisely because of these rate hikes coming. And in fact, I've increased my allocation to the dollar. And what we've seen in our research is that with inflation, the dollar actually doesn't weaken relative to the other countries, but it actually strengthens, in part because the Fed raises rates to respond, in part because a lot of the inflation really that we see is global. And ultimately, the U.S. dollar is still the most reliable currency that everybody flocks to. So I am more positive than negative on the dollar. More positive than the dollar than the Bitcoin.
Mm-hmm. Itamar, where's your money?
I find myself in the awkward position of being more of an optimist, and not my usual role. But I think that where I want to invest in is firms involved in investment, in physical investment, because relative to where we were before, I think it was too low. You can see that historically, and the switch to producing goods has led to a huge demand for more investment in these areas. So I think that's the tilt that I have.
Okay. Thank you. Thank you very much. Thanks everyone for joining us. I hope you enjoyed it. I hope you found it valuable, and I hope you come back for more someday. But it was great to have you for an hour. Kate?
Thank you.
Well, thank you, Joao. That is all the time that we have today. I'd like to thank our professors, Itamar, Nick, and Joao, for sharing their perspectives and insights with us. And thanks to our audience for joining us. If you don't already follow Wharton Executive Education on LinkedIn, please follow our page to stay up to date with Wharton thought leadership, as well as our program offerings. To join Wharton faculty and intellectually curious peers in an upcoming program, visit us at executiveeducation.wharton.upenn.edu. Thank you and have a great day.